10 lakh rupees. That's your entry ticket to India's newest investment option that just launched in Feb 2025. Okay, so imagine you're flying from Mumbai to Delhi. In a regular flight, the plane's on autopilot most of the time, right? The pilot follows a set flight path. There are rules, there's structure. Now imagine the pilot gets some manual controls. Not full freedom, you're still in a commercial aircraft with regulations, but they can now make tactical moves, navigate around weather, adjust the altitude based on real-time conditions. That's literally what just happened in the Indian investment landscape. For years, you had two main choices: mutual funds, structured, regulated, follow specific mandates, or PMS and AIF, which need 50 lakh to 1 crore and give fund managers significantly more freedom. But what if you had 10 lakhs? Not enough for PMS or AIF, but wanted more flexibility than what regular mutual funds offer. SEBI launched Specialised Investment Funds in 2025, and it sits right between mutual funds and AIF PMS. By the end of this video, you'll know exactly whether this is for you. Let's start with the most important question. What exactly is SIF? A Specialised Investment Fund is a regulated category that sits between mutual funds and AIF or PMS. Not as conservative as mutual funds, not as free-willing or high-ticket as AIF or PMS. Entry starts at 10 lakh rupees, so it's not meant for the retail masses, but it is accessible to affluent investors. Now, here's what makes SIF versus mutual fund comparison interesting. Let me break down the key differences. They can go short, unhedged, MFs cannot. In simple terms, a mutual fund can only profit if markets go up. SIFs can generate alpha whether markets go up or down because short selling is permitted. Number 2. Long-short strategies are allowed. Mutual funds largely run only long-only portfolios. SIFs let fund managers express views on both sides. I like this stock, I go long. I think this stock will fall, I go short. Number 3. More freedom for concentrated portfolios. Mutual funds must stay diversified due to strict SEBI limits. SIFs can concentrate more in high conviction ideas, not as free as PMS or AIF, but more flexibility than MFs. Number 4. Allowed gross exposure of 100% like MFs, but with far more strategic freedom. They stay fully regulated and capped, so no crazy leverage, but they can use long-short strategies. Number 5. Proper oversight, disclosure norms, no leverage, yet far more strategy friendly than mutual funds. Number 6. Better suited for volatility. Because the fund manager can play both sides and hedge, SIFs are designed to navigate through volatile markets better than traditional long-only mutual funds. Number 7. Structure reduces extreme risk seen in AIF category 3. SIFs offer more freedom but within a well-defined regulatory fence. Now, to really understand where SIF fits, you need to see the complete picture. SIF versus MF versus PMS versus AIF, the complete comparison. Let's break it down across 3 dimensions: access, flexibility and taxation. Mutual funds. Access minimum rupees 500, most accessible, perfect for those who have just begun their investment journey. Flexibility. Long only approach, cannot use leverage, derivative usage is limited to basic hedging. Stable, highly regulated but restricted in strategy. Taxation. Equity funds long-term gains at 12.5% after 12 months. Debt funds taxed at income slab rate. Now SIF. Access. Minimum rupees 10 lakh, more exclusive than MFs but accessible to affluent investors. Flexibility. This is where SIF stands out. Long-short strategies are allowed, derivatives permitted up to 25%, unhedged short exposure. No leverage allowed, more strategic freedom than mutual funds, controlled risk framework. Taxation. Similar to the mutual fund structure, long-term gains after 1 year at 12.5%, short-term gains taxed at marginal rate. Portfolio management services. Access minimum rupees 50 lakhs for high net worth individuals wanting personalized management. Flexibility. Offers customization but still long only. No leverage allowed and derivative usage is very limited. High customization but low strategic flexibility. Taxation happens directly at investor level. Every buy or sell triggers capital gains tax, often less tax efficient due to frequent taxable events. AIF Category 3 access minimum rupees 1 crore for ultra HNI investors. Flexibility most flexible of all. Long short strategies allowed, derivatives permitted, leverage allowed unique to AIF. Widest range of tools and taxation at fund level, not investor level. Capital gains 12.5%, business income 30% plus surcharge and cess. Investors receive post-tax distribution. Now everyone searching accredited investor requirements, thinking it's mandatory for SIF. Let me clear this up because it's actually quite straightforward. An accredited investor is someone who meets SEBI's high income or high net worth criteria, indicating they have the financial strength and sophistication to take on higher risk investment products. SEBI classifies you as an accredited investor if you meet any of these thresholds. Annual income of rupees 2 crore or more, net worth of at least 7.5 crore with half in financial assets or combination of 1 crore annual income and 5 crore net worth. Certain entities like large corporates, trusts and institutional investors also qualify if they meet high net worth norm. Why does this matter for SIF? Because accredited investors are considered financially mature. They are exempt from the standard minimum investment limit, meaning the usual 10 lakh minimum for SIF does not apply to them. For everyone else, the 10 lakh rule applies, which brings me to how that actually works. And there is an important aspect here. The SIF minimum investment 10 lakh applies at the SIF level, not per strategy. Let me explain. How does it work? You can invest rupees 6 lakhs in one SIF strategy and 4 lakh in another strategy within the same SIF. Total of 10 lakh rupees. The catch, you cannot let your total investments fall below rupees 10 lakh through redemptions. Here's an example. You have rupees 12 lakh invested. You want to withdraw rupees 5 lakh. Not allowed. Why? Because 12 lakh minus 5 lakh is 7 lakh, which is below the minimum amount for SIF. You can only withdraw up to rupees 2 lakh while maintaining the rupees 10 lakh minimum. Market fall exception. If your 10 lakhs drop to 8.5 lakh due to market decline, not your withdrawal, that's a passive breach. You are not penalized, but you can only redeem the entire remaining amount. No partial redemptions allowed. Can you do SIPs? Yes, systematic investment plan is allowed. But you must first reach rupees 10 lakh through lump sum investment. Once you are above rupees 10 lakh, you can add more through SIP. Now the most interesting part, what strategies can you actually invest in? The 7 strategies, understanding your options. But first, let me explain what long short actually means. What is long short? Going long means buying a stock because you think it will go up. You profit if it rises. Going short means selling a stock you don't own, borrowing it because you think it's about to go down. You profit if it falls. Long short strategy means doing both simultaneously. Buy stocks you're bullish on, short stocks you're bearish on. This way fund managers can make money in both rising and falling markets. Now, SEBI has approved exactly these 7 strategies. Let me break them down. Equity oriented strategies. Number 1. Equity long short fund. What it does? 80% minimum in stocks, up to 25% short exposure allowed. The fund manager goes long as stocks where they have a positive view expecting them to rise and can short stocks where they have a negative view expecting them to fall. Redemption daily. This is your basic equity long short fund SIF. Number 2. Equity excluding top 100 long short fund. What it does? Investment beyond large cap stocks must be 65% minimum. This means focus on mid and small cap companies, up to 25% short positions allowed. Think the fund manager focuses on emerging companies outside the top 100, going long on promising stocks while shorting the weaker ones. Redemption daily. Number 3. Sector rotation long short fund. What it does? 80% invested in maximum 4 sectors at any given time. Can rotate between sectors up to 25% short exposure at a sector level. Critical point: if they short a sector, all stocks from that sector must be held short. Example: long on technology and healthcare sectors, short on real estate and metal sector during their downturns. Redemption daily. Debt oriented strategies. Debt long short fund. What it does? Invests across debt instruments, uses exchange traded debt derivatives for short positions on interest rate movements. This is the debt long short SIF strategy. Redemption weekly. Sectoral debt long short fund. What it does? Minimum 2 sectors, maximum 75% in one sector, up to 25% short exposure at sector level. Example: long on banking sector bonds, short on corporate bonds in test sectors. Redemption weekly. Hybrid strategies. Active asset allocator long short fund. What it does? Dynamically allocates between equity, debt, REITs, InvITs and commodity derivatives, up to 25% short exposure. The all-weather strategy that moves based on market conditions. Redemption twice a week. Hybrid long short fund. What it does? Minimum 25% equity, minimum 25% debt, up to 25% short exposure across both. The balanced long short approach. Redemption twice a week. Remember, one fund house can launch one strategy per category. No proliferation. Now the practical question: how to actually invest? And it is straightforward once you understand the basics. The process. AMCs that launch SIF will have a separate dedicated website or web page, SEBI mandate. Same KYC process as mutual funds. Investment modes explained. Lump sum. You must reach Rs 10 lakh minimum to enter. SIP after entry. Once you're at Rs 10 lakh, you can start systematic investment plan for additional monthly investments. SWP is available. Systematic withdrawals possible while maintaining Rs 10 lakh minimum. STP is also possible. Systematic transfers from other funds keeping Rs 10 lakh flow. Redemption frequencies. Equity strategies daily. Debt strategies weekly. Hybrid strategies twice a week. Remember, the minimum SIF investment requirement is Rs 10 lakh at the SIF level, maintained throughout your investment journey. Now let's talk about what really matters, the risks involved. The risks, what you're signing up for. Because understanding risks is more important than understanding returns. Every SIF comes with a risk band. 5 levels from level 1, lowest, to level 5 being the highest. Evaluated monthly, SMS, email alerts when it changes. Risk number 1, derivative amplification. Up to 25% in derivatives means amplified movements. Works both ways, bigger gains and bigger losses. Short position risk. When you go long, maximum loss is your investment. When you short and the stock rises instead of falling, losses may spike. Risk 3, liquidity constraints. Not all strategies offer daily redemptions. Debt weekly, hybrid twice a week. Liquidity risk is real. You can't always access your money immediately. Number 4, concentration risk. SIFs allow more concentrated portfolios than mutual funds. Higher concentration means higher impact if a big bet goes wrong. Risk 5, complexity. Long short strategies, derivatives, sector rotation, these are complex mechanisms. Transparency. Portfolio disclosed every alternate month within 10 days on AMC and AMFI website. This is not SIF investment for beginners. This is for investors who understand market risks deeply. So who should actually invest? Here's the reality check. Is SIF for you? Consider SIF if you have Rs 10 lakh beyond emergency funds and core portfolio. You understand derivatives, shorting and long short strategies. You're comfortable with higher volatility. You don't need immediate daily liquidity. You know higher flexibility means higher risk. Stick to mutual funds if you're new to investing. You don't understand what shorting means. You prefer straightforward investments. Investments in specialized investment funds involve relatively higher risk, including potential loss of capital, liquidity risk, and market volatility. Please read all investment strategy related documents carefully before making the investment decision.